Hi guys, welcome back to my channel. So today I'm going to be talking a bit about dividend investing and my reasons for switching from my previous setup to my current plans, I guess, for investing, and what changed in my strategy and why. Let's just get straight into it. So originally when I started investing, in 2019, I think, late 2019, and my initial strategy was invest for the long term, invest for growth. That's it. Long term growth. Those were my strategies. So with that in mind, I built my portfolio off of index funds and ETFs, and originally actually it was built off of Vanguard's Life Strategy 100, which is a blended fund by Vanguard, and it worked really well initially. It worked really well for what I wanted and it got the job done. But as I progressed, I've talked about this in my why I left the life strategy video. If you're interested in that, I'll link it up and down below. But after deciding to leave the life strategy, and as my, I guess, mentality towards investing kind of started to change, I wanted to try new things, and so I left the life strategy and then I built my portfolio off of the global all cap index fund through Vanguard. That is like the main chunk of my portfolio. And within that as well, I added some new things because I decided to add dividend investing to my strategy. As I said, originally I was going for growth and I was going for long term. I did not have any plan to add any dividend stocks to my portfolio, and I didn't want that to be the basis of my portfolio. But the biggest thing I think that turned around for me was when I decided to start working towards F.I.R.E, financial independence, retire early. When I decided that I was moving towards going for financial independence, that changed how I thought about dividend investing. So I'll quickly explain for anyone who doesn't know. Dividend investing is you build up a portfolio of dividend giving stocks and companies, ETFs, etc. And that portfolio, every quarter or once a year or biannually, these companies will pay out a dividend to their stockholders based off of a percentage each year. There will be a set price. Each quarter they'll announce it before when the payment is supposed to be due, how much you will get per share in dividends. A lot of big companies do this because they're established and they have made most of their growth, and so now they're just giving money back to the investors later on. So you'll find that a lot of tech companies don't really have big dividend payments because for the most part they're constantly innovating and they're constantly trying to grow, so they don't pay as much a dividend as other companies. You'll see that some companies don't pay dividends at all, like Google. Google does not pay a dividend. They haven't paid a dividend and they haven't announced any plans to pay a dividend yet. So that's crazy because, you know, they're a huge established company, but they do not pay dividends. They instead reinvest all that money that they make from their profits into building bigger, better products. And same with like Tesla. Right now they're not giving any dividends away, they're focused only on growth, and so they are keeping all their profits to reinvest back into the business and grow it. That also explains kind of what dividends do to companies. So generally if a dividend is being given out from a company, that is profit that won't be going to them for that year. A lot of the time the big debate about dividend investing versus growth investing is that dividend investing and growth investing are essentially the same thing, because if the company keeps their profits, it just makes the value of the stocks go up. However, if they give their profits out, you may be receiving money and you may be receiving a certain amount, but that just devalues their company shares and the company's stock, if that makes sense. I feel like you could make a whole video on the psychology of dividend investing versus growth investing. It's something that people will debate until the end of time, I'm sure. Yeah, I decided to add it into my strategy when I decided to start going towards financial independence. And the reason I did that was not only because I wanted to try something new and I wanted to add a different type of revenue stream into my income, but it was also because I saw that although dividend and growth investing essentially would yield the same result, they both work differently in different circumstances. And that was one thing that made me want to add it, because when you know what happened, the stock market essentially kind of crashed. But one thing that did survive in that moment when everything had gone to like zero. If you were doing F.I.R.E and you hadn't drawn down enough to cover you for this upcoming event that you had no idea was coming, then you would have been essentially screwed, because if you would have had to take that money out, you would have been taking money out at an extreme loss, and it would just affect your portfolio crazily for who knows how long to come, and it would take so long to recover. However, if you had some dividend income coming in, for the most part, when it all happened, dividends were still going as normal. So a lot of companies were still paying their dividends, which is why it's always good to diversify and not focus on one company. So dividends were still being paid out, and things were essentially okay on the dividend front. There were some companies that later on, as things progressed and they realized that this is a long-term thing and not going away, they have withheld their dividends, such as IAG, which owns British Airways, and who is it? Someone has their, oh, Carnival. I'm just talking about things that I have in my own portfolio that I know have withheld their dividends. Carnival, IAG have withheld their dividends to 2022 and 2023. So some companies have now withheld their dividends, and they're using it to put the money back into the company so it can grow and recover from this thing that has happened. So yeah, dividends weren't really affected that much in the beginning when this all happened. However, the stock market crashed. We'll just say crashed because that's what happened. I still remember it like it was yesterday. As I said, if you were just focusing on growth investing and you didn't have a backup plan other than cash reserves, you essentially would have been screwed. And it made me think that I should be more open to other income streams regardless of what is logical, you know? Because sometimes we do things because we're like, oh, this is logical. Dividend investing doesn't make sense because like the companies are just going down by an equal amount of value. If you just focused on growth, you would get the same amount of returns and then eventually the same amount of money, etc., etc., so on and so forth. But I like diversity, and I like to cover myself just in case something happens. And that's why I have decided to add it to my portfolio, and I just want to cover my bases. I feel like anyone who started investing just before everything that happened really got a crash course real fast, and I definitely got that crash course. So yeah, I've decided to add dividend investing to my portfolio, and if you guys are interested, I maybe will just go through my dividend portfolio and the companies that I'm now invested in due to that, because I don't ever make Vanguard updates. A majority of my dividend investing will be happening in Vanguard. So yeah, it's not something you guys would ever really see because I usually only make updates about Trading 212 and Free Trade, and that's not really where my focus of dividend investing is, because there's the general accounts, the general investing accounts, and they are taxable. So I can only make up to £2,000 in dividends, which I'm nowhere near yet a year. So when I get there though, then yeah, I guess that we'll be having different conversations, because to make that amount anyways, you would have to invest quite a bit. Let's do that. Let's do the math on that. 2,000, 0.0. On average, I guess about 3%, let's say, would be my dividend yield. To make £2,000 a year with a 3% yield on dividends, I would have to have £66,666 invested. Do you know, I always thought about my non-tax advantaged accounts, and I'm always like, oh my god, I'm worried. But I don't know why I'm worrying, because for me to get there, at that point of worry, I will have to invested a lot of money, and I doubt I will be doing that in those accounts anyways. So yeah, it's not really a thing to worry about, but it is interesting and it is exciting because it's made me think so much about the different companies I invest in, the way I invest. Before, I was super just against not against, but I wasn't really about individual companies and taking that kind of risk, and it's crazy how things have changed. And now I'm like, what companies are safe for me but risky enough that I will get a good enough dividend yield and that they will be around for a very long time. So that's one thing that hasn't changed. I'm still investing for the long term, and I'm still investing for growth. So that's also something that hasn't changed. I am still investing for growth. So the companies I invest in are companies I would have invested in anyways, regardless of if they gave a dividend or not. There are some interesting ones that I might not have chosen if everything that had happened hadn't happened, because they probably weren't as great a deal as they are now. That is it for this video. I just wanted to give you that update and to let you know how things have changed. Let me know down below if you are doing dividend investing or planning to try it, or if you've tried it before and have moved away from it. I think that's also an interesting one because I know some people have moved away from dividend investing. I will see you guys next time for another video. Until then, take care.